Welcome back to the second hour of today's Butler on Business, and joining us now is our hard money guy, our silver and gold expert, David Morgan of the Morgan Report out of the Pacific Northwest. So it's 10 after 8 out there, and congratulations to you on the Seattle Seahawks big victory this weekend.
Thank you.
David, I know you're following the situation where the Germans back in the 50s deposited 675 tons of gold with our Federal Reserve, asked to come check it out about a year and a half ago. The Fed turned them away. They came back a second time. The Fed showed them a few bars and said they couldn't let them see the rest of it. They were adamant, and finally the Fed opened up a room and, kind of did the old quick, take a look, shut the door. And then the Fed agreed to repay the Germans over a 7-8 year period. Last year, they were supposed to return roughly 90 tons and gave them 37.5 tons. And lo and behold, it's not even the gold that Germany had deposited with the Fed. What do you think is going on there?
Well, I think it's a clear indication that the physical gold market is in dire straits. The amount of hypothecation and swaps, leasing, all these derivatives that have surrounded the precious metals is way, way, way out of control. And this happened, as you said, a little more than a year ago. I remember I was in the Vancouver Gold Show 1 year ago, and I was really, I had my interview on TV up there, and that's all I talked about really was this, give me a break. You're telling me that I can't get my gold back for 7 years? That's a clear indication they don't have it. If they had it, they get it back. And whose gold is it anyway? I mean, if it's supposedly in a depository at the Feds for safekeeping, it's a safekeeping account. They're supposed to be able to get their own property back. And this gets ignored by the mainstream press for the most part. But there's other indicators. This Ampro, I'm probably mispronouncing a bank, this Dutch bank that had, physical gold, and these people had to settle for cash. And this is happening. So there is, as I've always said and many others, the day of reckoning is when the physical market starts to seize up. And it's starting to seize up, but I guess not at the level that we need it to in order for this, price discrepancy to take hold. I mean, you can have a cash price on the futures market, and all you can do is settle in cash, or you can have a price that dictates you get the physical reality. And this paper paradigm versus the physical reality spread is widening and will continue to do so. And at some point, I think that there'll be two markets and then only one market. Eventually, there'll only be a physical, market. But right now, of course, there's all kinds of derivative markets. This is really, really bad news for people that own gold in a derivative form that think they own physical. This is the problem. There's a lot of people that have trusted bank source or whatever, and they have a certificate with a quote-unquote trusted source. I mean, I think it was Morgan Stanley that was fined not all that heavily for silver accounts, and there was no silver in these accounts at all. And yet here's a mainstream, headliner bank that was purportedly storing physical silver for these people and charging them storage fees, and they didn't have any silver. And how much of that is going on, we don't know, but we know that there's probably more than that than most people want to recognize.
Well, I think back a year ago, last January, the unusual trading that took place in SLV, and there wasn't that much physical silver floating around there for them to supposedly make that big buy. So you threw out the term hypothecation and then rehypothecation. For those who may not be familiar with the terms and how they apply to the precious metals, could you elaborate on that briefly?
Yeah, sorry for the big words. Really, all it is it's a way to it's a derivative. It's a way to take a physical thing, it could be wheat even, and say that I'm going to give you a piece of paper that allows you to, and you can make this stuff up, and it is most of the time. I'll give you delivery of this much gold in the future at this price, that kind of thing. It's like an option. It could be anything, but it's a way to take some physical reality and make a derivative of it. And then that derivative is a rehypothecation. So you say, here's a piece of paper, Alan, I'll deliver you this much gold. And then you take that piece of paper and you say to your friend John, I'm going to, starting on this day, I'm going to lease you this gold for this many months. And then he takes that piece of paper and just goes on and on and on and on. So you can see how this thing can be such a mess.
David, while I do the show, I'm also streaming television, and lo and behold, I just saw your face pop up twice on a Monix.com commercial.
Oh, that's funny.
Yeah, I'm just sitting there thinking, I'm talking to that guy right now. What? I guess they were quoting you as a expert on the precious metals market.
Well, I haven't done anything with Monex in years, but very early on, the silver market. In fact, before silver made $10 an ounce, I did an article and went into Orange County, and I lectured for about an hour all the brokers in the Monex facility there. And then I did the rest of the day doing a tape interview with one of their guys that they clipped down into very small, sound bites, I guess. But it was very interesting at the time because they wanted me to write a paper on why silver would go to $10 an ounce. If you can believe it. It was that long ago.
I know you're familiar with the jobs report that came out. I'm fortunate enough to have the former commissioner on. We didn't add 74,000 jobs in December. We lost a 250,000. The various central bank guys, Fed governors are already coming out saying we shouldn't be tapering. We should be increasing the amount of money printing that we're doing. Isn't all of this bullish for the precious metals?
Well, I agree with Doug Casey, or he agrees with me. It doesn't matter, and a lot of us. A lot of people say, well, you need inflation for the metals to go up, or gold's an inflation hedge, and you hear that constantly. But I like to think of it as an uncertainty hedge. Look, people, in times like these, people want something they can trust. And when confidence goes down, they seek it even more. And right now, the big confidence game is in, the Treasury market, really. It's the U.S. dollar still. And that's the mainstream thinking, and everyone, many people are brainwashed in thinking that's the most secure thing you can have, but it's not. It's not by a long shot. The most secure thing you can have are the precious metals. So in times of good times, bad times, and different times of uncertainty, in other words, volatile times that you don't know the future, times when the con game is coming to an end, when you can't trust, the bankers, you can't trust the system, you can't trust all these things. That is the time, and this is the conditions we are in, where people gravitate to the precious metals because it's something that's been trusted by human beings for many, 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 hundreds, if not thousands of years. So that is the argument that it doesn't just follow inflation. No, it follows uncertainty. It follows conditions of trust, and the trust is breaking down internationally as well as, on the street level.
Could you explain how even in times of deflation that the precious metals actually are a safe haven?
Well, there's the best study on it is Professor Jastrom in the Golden Constant, and he did gold versus a basket of commodities and saw what it did during deflation, and his conclusion was that gold does better in a deflation than in inflation. The problem with his analysis, and it's hard for me to critique Professor Jastrom, was that it's hard to ferret it out because in a lot of those conditions, gold was the money at the time. So, and today you're on a non-gold, fiat-only system. So it's hard to equate exactly. But nonetheless, the study's pretty conclusive that, that gold does fine in a deflation. In fact, if you're on an honest monetary system, you generally get a slight deflation, which is actually beneficial to people. Because what it means is stuff we already know, that the productivity of the human being increases. In other words, your cell phones produce cheaper because there's better methods to do it. You learn whether you can, make it better, faster, cheaper, et cetera. And so that drives the price down or downward. Deflation is technically a decrease in the money supply. What I'm saying is the prices of things go down generally. So you have a general overall benefit that your money goes further in an honest monetary system. The deal between, gold and silver is primarily that an ounce doesn't change, and it's a constant, and you have something that you can rely on so that you know that X amount of ounces today is going to buy you the same amount of stuff 10 years from now, 20 years from now, 30 years from now, 40, 50, 60, 70, whatever. So you don't need a financial planner to know what your money's going to be worth in the future. You know how much you have to save based on what your lifestyle is or what your plans are, that type of thing. But in today's world, it's also convoluted. Everyone makes an assumption, well, we're going to assume inflation is this, and then we're going to this, and then we're that. And it's all convoluted because no one knows the future. Not that you do it a gold standard, but you have a much better idea of what the monetary value is going to be in the future than you do today.
This is David Morgan. Again, you can get to David with the Morgan Report. Spell that out, MORGAN report.com. David, it's a pleasure. I'm going to miss you next week while you're attending, the Gold Show in Canada?
Precisely. Thank you.
All right.
I'll be looking for you in a couple weeks.
All right. Thank you.
Silver123.net is a silver saver program designed to be as simple as possible. For as little as $50 per month, you can set up and create an automatic cost average buying program that will get silver or gold sent to your door on a monthly basis. The first step to creating an account is easy. You will supply some basic information. Next, you will add a bank account from which you will schedule your purchases. Scheduling purchases makes saving easy. Silver Saver is customizable and allows you to control the amount and the date of purchase. Once you are signed up, you are then given your affiliate code. Now you can save in precious metals and also market this program. You can use email, web pages, and multiple forms of social media to share the Silver Saver program. Silver Saver will reward you generously with physical silver or gold whenever someone you refer becomes a saver. Silver Saver not only provides you with a share code, but also allows you to place your own banner ad on a website of your own. Silver Saver is one of the best ways to start saving and accumulating gold or silver, especially at these levels. Visit silver123.net and start saving today.